and welcome to Friends That Invest. You're joined today by your host, Sim. I'm a financial author and investor, and I'm here to help you learn about all things investing and personal finance. This week's episode is a fun one. I know I always say this about like every episode, but you know when you put like a lot of time and effort into something and you're like, wow, this is like, I'm so excited to speak on this. I came across essentially a really interesting graph that showcased all the different asset classes over the last 10 years, and it allowed me to understand which asset classes did really well, which did really poorly. I put my little analysis hat on. I was like woman in STEM, except like woman in finance, and you don't have to do all the hard work anymore. I've done it for you, and I've wrapped it up in a beautiful, quick, nice, easy episode so that you can be super smart and just be like at the water cooler at work and be like, oh yeah, like small caps didn't actually do that well in 2017. And everyone's going to be like, wow, like Jess is so freaking smart. And she is. She just had to listen to a podcast to know all the information in really simple and easy terms. Now, before we get into it, if you had to guess the best performing asset class of the last 10 years, you probably would have said US stocks. And in all honesty, maybe for some of the years you would have been right. But when you look into it, past like the headlines, past like the assumptions that we have, when we look at the calendar year total returns from 2016 to 2025 across 11 major asset classes. So this is large cap stocks. This is mid cap stocks. This is small cap stocks, growth stocks, value stocks, emerging market stocks, developed market stocks, gold, commodities, REITs, and bonds. These are all the different asset classes. And if I was to say to you, hey, investy bestie, what is the best performing asset class? You probably would have said large cap. And that has not always been the winner every single year. And in some years, it's been one of the worst performing asset class, which surprised me. So if you are wondering what is the best performing asset class by each year over the last 10 years, in 2016 was small cap. So companies that had very small market capitalizations, they grew very fast and they were up 27%. In 2017 was emerging markets. And emerging markets is like the fancy way of saying companies that have come from a country where the country is still developing and growing, but rather than calling it like a developing nation, that is not the correct way of saying it. We like to say emerging markets because it's emerging. It's not developing, it's emerging. And that was up 31%, which was huge. Now, 2018 was a bad year because there was no asset class that made a positive return. And the only asset class that didn't make a negative return and therefore was the best performing asset class, because everything else was like minus 5%, minus 10%, minus 20%, was aggregate bonds. And aggregate bonds had a return of 0%. It's like when everyone else fails so badly in a test that you end up doing really well because everyone else was just so crap. It's not like you were very good, but like in comparison, you're like, oh, I got a 0%, but I'm number one because everyone else got like minus 10. That's what happened to aggregate bonds. So congratulations, aggregate bonds. Now in 2019, year before COVID, beautiful time, we had no idea what was coming, was value stocks. And value stocks were up 31%. And I just know Warren Buffett was like having the time of his life that year because value stocks are Warren Buffett's specialty. It's what he's known for. He says, you know, buy really good companies at fair prices, see if there is some underlying value where the intrinsic value of the company is lower than the market value, like what it's trading for. So he had a good year, and I'm sure a lot of people thought, awesome, I'm going to invest in a lot of value stock and see what happens next year. 2020 hit. Value stocks were not the highest option. It was actually growth stocks, and growth stocks had a 33% year-on-year rise, which is huge. And so you might be going, okay, Sim, 2020, growth stocks. I'm going to invest in 2021. I'm going to do growth stocks again. No, you silly investor. How could you ever think such a thing? It was not growth stocks that did well in 2021. It was then REITs, real estate investment trusts, or REITs, which is basically a fund filled with lots of different property assets, property mortgages. So investing in property without like having to be a landlord. And those were up 41%, which is still not the highest that we've had in the last decade. And I'll tell you what the highest is in 2025, but REITs were up. It was not growth stocks. Then in 2022, you might go, okay, well, REITs were up. Let me buy more REITs. That will probably do really well next year. No. How immature of you. Sorry, I should not say this, but it just goes to show like how you think if one thing did well one year, you should just do it again the next year. And this data just surprised me so much because that is not the case. And so commodities in 2022, things like investing in oil and wheat and like barrels of crude oil, those were up, and that was up 24% in 2022. So you might be sitting there and going, okay, well, it was value stocks and REITs and commodities, so maybe I should just invest in that in like 2023. And 2023's top performing asset class was growth stocks. Not commodities, not REITs, not value stocks. It was growth stocks, and it was up 29%. And so now you're probably starting to remember some of this, especially if you've been investing for a few years. I don't remember anything more than like a year ago. My memory does a really good job at being like, let's shut that down. Let's box it away. What happened in 2017? No recollection. Where was I in like 2021? I'm sorry, that's like more than a year ago. I don't know. But you might remember 2024 and 2025. So take a guess, what was the largest growth in 2024? Which asset class was it? If you had guessed growth stocks, you were correct. They were up 34%. And last year, just like last year alone, 2025, what was the highest performing asset class in 2025? I'll give you a second to think about it. It was gold. And it was the highest return of all returns over the last 10 years, and it was up a whopping 64%. And so when you look at the years and it goes small cap, then emerging markets, then aggregate bonds, then value stocks, then growth stocks, then REITs, then commodities, then growth stocks, and then gold, you realize there's like absolutely no pattern as to which asset class is the best performing. And you might be listening to that and going, oh, Sim, like, that's a little bit stressful. I can't guess what's going to do well, but surely I can guess what's going to do poorly and at least make sure I'm not losing out. Like I'm going to, try and hedge my bets. And so now in chapter 2, let's run through the worst performing asset classes over the last decade and see if you can get any of these right. So in 2016, it was bonds. Bonds only returned 2%. In 2017, it was TIPS, and TIPS are Treasury inflation protected securities, which are basically just like government bonds. So 2016 were aggregate bonds. 2017 was government bonds that returned a -3%, worst performing. 2018 was emerging markets at -15%. Which is why, like, when people say emerging markets are like the best thing ever, I always say, I just don't know about that. And then 2019 was TIPS again. So again, bonds only returned 8%. So it was a really good year. The worst performing asset class returned 8%. Like that's more than the average. 2020 commodities were down 24%. And you have to remember in 2022, commodities were up 24%. Then in 2021, the worst performing asset class was gold at -4%. Then growth stocks at -29%. 2023 commodities at -6%. 2024 bonds at 1%. And 2025 were REITs, real estate investment trusts, at 3%. And I remember reading this and being like, oh my God, I'm kind of like getting whiplash off the back of this because this is very confusing. One year it's this, one year it's that. One year REITs do really well, one year REITs do really poorly. So what exactly are the trend lines, or like what is the thing that I need to know, Sim, from this data to make me a better investor? And there are a few trends that I have been able to pick up that I'm going to share with you. The first trend is that chasing last year's winners is just a surefire way of losing money. You cannot look at what did well last year in any year of the last 10 years and go, that is a guaranteed like investment. I'm going to 100% make money, because REITs were up 41% in 2021, down 26% in 2022. Growth stocks were up 33% in 2020. You'd be like, oh my God, that's amazing. Let's keep buying growth stocks. Down 29% in 2022. Emerging markets were up 31% in 2017 and down 15% literally a year later in 2018. And commodities were up 24% in 2022 and then down 9% in 2023. It's almost funny in the way that you can invest in something and be like, I am just like so smart, I'm doing my research, but I guess they're not wrong when they say past performance is not a guarantee of future success. Like, you will always catch me saying that and kind of like sometimes rolling my eyes when I say it, because I'm like, yeah, we know, da da da. But I guess it's like genuinely true. If you look at past performance and go, well, last year this did really well, therefore next year it must do really well as well, you will end up losing so much of your investments that you'll probably be put off it forever. And I'm sure there are probably a lot of people that invest that way, where they're just basing it off what's happened in the past instead of doing what we know to be like true and to be more of a safer strategy, even though there's no strategy that's like completely risk-free. Dollar cost averaging, buying broad market index funds, having a diversified portfolio of shares and bonds and commodities and like precious metals. That's probably like the safest bet across all the different strategies, because even just like looking at past performance, it doesn't really help. Now, the second trend that I noticed that was like more surprising to me than anything else is that bonds have had a really bad decade. Like 2022 was such a rough year. Stocks were down. That's okay. We're like, stocks are down. You know, the Bogglehead method or the lazy portfolio method said that when stocks are down, bonds tend to be up. They kind of balance out. 2022 comes around. Stocks are down. Bonds are down. They're both down. And you might be sitting there in 2022 and you might have been going, oh my God, like, how do I make any sense of this? Sim said that stocks go down, at least bonds go up. Now they're both down. Like, this is like feast or famine for me. And in 2022, the only winners really were commodities, up 24%, and gold, which was like a minus 1%, which is basically like a flatline answer. And when you think about it, when you get told, hey, have a 60% investment portfolio of stocks and a 40% investment portfolio of bonds, you know, the 60-40 rule is something that comes up time and time again. It kind of comes across as a safe and standard method. It just goes to show that sometimes, even despite the best level of like high quality financial education, like the, you know, absolute principles of investing, like saying having stocks and bonds is important is like saying you should exercise and eat whole foods if you want to be healthy. Like, it's just, it is known almost as common sense. So for bonds to not do well, it's like quite a uncomfortable feeling. But in saying that, I'm not here to write off bonds and say that because bonds have done poorly in the last decade, they don't have a place going forward. I still believe in a portfolio where I have a little bit in bonds, but it just has gone to show me that also including commodities and also including gold as part of my overall hedge strategy is better than just shares and bonds. I think it's going to be more like shares and bonds plus gold plus commodities. And therefore, whatever happens, I'm like, okay, one of you should go up because you're down, bonds are down, shares are down, but like gold has come through or commodities has come through. Like, thank you, crude oil. I am just very grateful for you today. And the final trend, the one that I am really surprised by and probably will get a little bit of flack for, is that emerging markets are, in my opinion, too risky to be a large part of your investment allocation, unless you are, of course, really comfortable with a large level of risk. I've seen a lot more discourse when I talk to the investee besties. A lot of them have said, Sim, I'm scared of the US. I don't know what's going to happen in the next 5, 10, 20 years. And to that, I say touche, like, does anyone? But they go, I'm scared. And should I move more of my money into emerging markets? Like, should I invest in total world funds that like exclude the US or specifically in emerging growth funds? And I've always been a little bit hesitant, and I've been very scared to share my opinion because, again, like, I don't know what will happen. No one will know what will happen. But if I can go off the data, there is just like too much of a volatility, in my opinion, to look at emerging markets for like it to go up 31% in 2017 and then to drop 15% in 2018. But then you could also argue, well, sim growth stocks were, you know, up 35% in 2024 and then down 29% in 2022. It's a valid point to look at emerging markets and on one hand say, yes, they're really risky, but so are growth stocks. I think where I'm coming from is don't make emerging markets your main portfolio. I still believe diversified broad market index funds give you exposure to a range of different companies and sectors, and having a smaller part of your portfolio in emerging markets is not necessarily a bad thing, but it becomes like having, growth stocks. And to kind of wrap up the emerging market point, there has been so much geopolitical risk that is only going to rise up more and become more of an issue to the point where I don't see it as a safe bet. Like when you have your 3-fund portfolio and you've got an international fund, a US fund, and a bond fund, I believe that international fund covers your emerging markets and there's not necessarily a need to change your US stocks into more emerging countries. I think that's like, oh my God, I almost got like goosebumps just thinking about it. Like it's quite a risky investment strategy to have. And in all honesty, the final trend that I'd learned is that you just need to stay the course. Like I was looking at the data and an investor who maybe got really scared and sold down their growth stocks after the 22 crash and, had a 29% loss, they would have then missed 2023's recovery and 2024's surge where it went up 29% and then 35%. And an investor who was like, oh my God, my bonds are down, it's 2022, they would have ended up having a multi-year recovery if they had just saved and not pulled out anything. What the last decade has shown us, again, even though past performance does not guarantee future success, is that just because you have one bad year in the market or one bad 6 months or one bad quarter does not mean that this is where the market is going to head. For example, if we think about the future, again, I cannot predict it, neither can anyone else. But if we look at what's done really well these last couple of years, it's been our growth stocks. In 2025, growth stocks did not do as well as they have until now. Last year it was gold, and yet at the time of recording in the start of July, we're actually seeing that gold is not performing very well. It's dropped quite significantly despite being the highest performing asset class in 2025. And so if you just do the simple things that all financial professionals recommend, which is dollar cost average, invest in broad market index funds, have a little bit of exposure to international funds and have bond funds, as well as maybe exposing yourself to a little bit more in gold or silver or other commodities, then no matter what happens, as long as you keep dollar cost averaging and not getting scared and panic selling and pulling your money out, you are managing your risk a lot better than someone else that goes, oh my God, growth stocks are doing really well, let's just put all of my money into it. Oh my God, now gold is doing really well, let's just put all my money into it. Oh my God, now small cap is doing really well, let's put all my money into it. And so it just goes to show the power of doing the simple and boring stuff is the strategy that ends up paying off. And that's why I love looking at this kind of data, because it is just so fun. And I hope you have enjoyed nerding out with me. If you found this episode helpful, please, please, please take a screenshot, put it on your Instagram story, tag friends that invest. It helps us grow the podcast so much. And what more can we ask for than a world where more women learn about investing and personal finance and have more financial stability? So with that, I'll see you next week.